Yo, what up, what up? Welcome to a new educational video. This week we're going to be talking about breakaway gaps. Now, many of you probably had a trade setup lined up for you and then you did not get tagged in that fair value gap you had your limit order in, right? And we're going to be talking about how to determine this breakaway gap. So let's start off on the next slide. What are breakaway gaps? That's what we're going to be talking about. How to determine those breakaway gaps, because if we can determine them, we can use them to our advantage, right? So at the end, I will do a little simulation as well, so you can follow my thought process on how to determine them. So yeah, what are breakaway gaps? So first of all, if you are unsure what a fair value gap is, then I would advise you to go back into ICT's YouTube and follow his mentorship. But breakaway gap is a fair value gap, so it's classified as an imbalance. And these gaps are formed by price willingly pushing in one direction, right? So with only pushing in one direction, it will only offer one-sided delivery. And I will show you on the chart in a bit how that looks like. And obviously what makes it a breakaway gap is that price did not return back into that fair value gap. So over here we have a chart, this is a EuroCAD chart. We've got a breakaway gap here. First of all, why is this a breakaway gap? Price is willingly pushing in one direction, right? So you can see they're closing willingly to the upside, no return in any of these gaps. So technically these are all breakaway gaps. There's no return in this little gap here, no return in this little gap here, and no return here. So they're all breakaway gaps over here. Now what are breakaway gaps? Again, those fair value gaps did not get retraced into, so there are open fair value gaps. How can we determine those gaps to stay open? We're going to be talking about market structure. We're going to be talking about balanced price ranges. We're going to be using the PD array matrix. And then in the end, I will show you a time frame sequencing for open, low, high, close, or open, high, low, close. So how to enter a trade with knowing that there's a breakaway gap above you or below you. So let's talk about market structure first of all. We've got a crude schematic over here, right? We've got some consolidation with buy side liquidity above it, a dip, and then a break of structure. Now, let's say there's a breakaway gap below us, right? Why is there a breakaway gap below us? And this is because of market structure, right? We're forming a short-term low here, then it dips below that short-term low, creating an intermediate term low if there's another short-term low to the right of it, right? So once price starts to break up above this structural high, we can assume this is the new dealing range, right? And then this new dealing range should stay respected. So every fair value gap which is below that structural low, the intermediate term low, should stay in open, right? So this should stay open. So this is a very simple way to determine that there's a gap below us that will stay open. Obviously, we're going to use a little bit more than that, but this is one thing you can use, which is market structure, right? So let's look at the chart here. It's that same EuroCAD chart. We've got break of structure over here, rate on liquidity prior, right? Just like the schematic we saw earlier, we have all these gaps here which are untapped, and we can actually see that there are swing lows formed down here. And the most important part is you want to see a swing low or a swing high form on a PD array, right? So let's say it forms inside a fair value gap, or on an order block, or on a breaker block. That makes that swing low more probable to hold, right? And you can see because we are forming low, higher lows, all these gaps below here will stay open. Let's head over to balance price ranges. This is also an important technique you can use. I already have a video about it. It's called Redelivered Rebalanced. You can watch that as well. We'll put a link in the description. And how does that look like? We all know fair value gaps can be used as support and resistance, right? So we have the same sort of crude schematic, buy side liquidity above us, right? Rating sell side, and now we're looking for buy side liquidity again. We got a little fair value gap below us, but in the process of going down here, there is a bearish fair value gap. So this blue box is a bearish fair value gap. Once we trade above a bearish PD array, right, that bearish fair value gap, once price comes back in it, it is rebalanced. So if we trade out of it again, we should respect this as a strong low. And now you can use market structure again, right? If there's an intermediate term low formed, we should have a new dealing range here. So price should not come back below this low, and any gap that is below this low should be a breakaway gap. Now, how does that look like on a chart? This is a GBP USD chart. We've got bullish fair value gaps here, right? So if we are bullish, we should keep respecting those fair value gaps. We've got a smart money reversal up here. Little note to make: if there's a smart money reversal, you want to see SMT with it. It's an important part of a high probable smart money reversal. Also have a video about that if you want to check it out on the channel. We form a bearish fair value gap here, and now we're breaking down, breaking structure here, and then we're closing below this balanced price range, right? Why do I have a key here? And we'll explain you in a second. Then we break lower and lower and lower, and over here we also have a balanced price range, but we do dip into this fair value gap. So we did not dip into this fair value gap, but we did dip into this fair value gap. So what is the difference between this one and leaving this open and this one not leaving it open? That's why the key is here. We form an opposing array in this bullish fair value gap, right? So we have a up close candle here, which should resist price lower. And another thing to note is that this balanced price range is below the other fair value gap, right? And you can see here, these are overlapping. So we have this fair value gap here, but it's overlapping with the fair value gap over here. So it can still dip back into the fair value gap, making it not a breakaway gap, right? So that's how you can use the balanced price range. So let's look at another chart over here. First of all, price is going down, right? We want to aim back for that sell side liquidity, buy side liquidity, my bad. We've got a bearish fair value gap here. Price is pushing back into it, respecting it here, right? So it's a key fair value gap, trading down lower, and now we're displacing up higher. So we have a little gap here. Why is that gap not getting traded back into? Because we had that BPR here, which was previously used as a resistance level, now being used as a support level, right? So once price fails to continue up higher above here and starts to break below, let's say, this fair value gap here and breaking structure, now we can return back in fair value gaps which are in discount. Same thing happens over here. We've got this bearish fair value gap, right? Price trades lower. We have an initial reaction here, but we fail to respect it, closing above it and using this balanced price range now as a support level. And then once we hit buy side liquidity, we can return back into the fair value gap, right? It will be external back to internal, but that's a topic for another video. So this is how I personally use the balanced price ranges to determine breakaway gaps. Now let's talk about the PD array matrix, also a good tool to use to see if there's a breakaway gap. And this is actually my favorite way to determine a breakaway gap. So let's look at this chart over here. Again, EuroCAD with the breakaway gaps, remember from the previous charts. And within the PD array matrix, there's an order block, a breaker, and a fair value gap. You can use these, right? So first of all, down close candles in an uptrend should support price higher, right? We don't want to see those down close candles get violated, because those are the order blocks that should push price up higher. We've got a breaker over here, right? So price closes above, break structure, and then we're respecting the breaker over here. Now, it's not guaranteed yet that these gaps won't get traded back into, but you can determine whatever is below the breaker that will stay open. So once we trade above the breaker, we can determine that this will stay open and this one will stay open. But there's still one over here. This one is not confirmed yet, unless we start to respect those down close candles, right? So now we're using the PD array matrix to determine the breakaway gaps below us. So these we can determine because of the breaker resting above it. And now these we can determine because we are forming down close candles and price is respecting that every time. And you can see never closing below those down close candles. And importantly to know, the bodies are the most important part here, because if the bodies close above or within those down close candles, it's still valid to go higher, and the wicks, right, like ICT says, the wicks do the damage, right, and the bodies tell the story. So always go with body closure in determining if a certain PD array is respected, yes or no. Now let's talk a little bit about time frame sequencing for the open low high close or open high low close. How to get into a trade, right? If you have a let's say price is displacing away on a 5-minute time frame and you're trading a 1 minute, and there's a 5-minute fair value gap, but it never comes back into that 5-minute fair value gap. And we can use other time frames as well. So let's see how that looks like. So we've got a breakaway gap here, but it's not validated yet on this time frame, right? This is a 5-minute time frame. We don't know yet if this will stay open, but if we zoom into this piece of price action over here, we can determine that this gap will likely to stay open. So now we're back at those PD arrays, right? This is the same chart with the breaker, with those down close candles, which should support price higher. Now, what I always like to do, let's say I'm trading a 15-minute time frame, right? I want to see the 15-minute candle open up and then trade lower first and then continue up higher, right? So they have an open low and then a high and a close. So that's what I always try to do on every time frame. Wait for that candle to open and see if there's on the time frame below it, there is a PD array where it should bounce away from. Like, so over here we have a 5-minute opening. This is a 1-minute chart, obviously, but we had that breakaway gap below us, right? We know it will be a breakaway gap because we start to close above these down close candles, and that is before this 5-minute candle opens up. So you can see this 5-minute opens up, does a little dip lower, open low, and then a high and a close. Same thing with the next 5-minute candle. We're closing above these down close candles, and then this 5-minute candle opens up, makes a little wick lower, and then continues to close higher, right? So this is how you can use the next candle opening price to see on one time frame lower, to see where it should dip and where it should respect, and then where it should trade higher towards. Now, how to use breakaway gaps in your trading. I'm going to be looking at this chart over here. We've got a GBP USD chart. We've got a sales or buy side rate here during Asia range. Always mark out your New York midnight opening price. And now, how do we determine where we can get in over here, right? We see all these gaps up here. We see a structural low form here. We probably want to sell above New York midnight opening price, right? And enter in any of these fair value gaps in premium. But price never reaches back into premium. So why is that? First of all, always mark out SMT, right? SMT is a high probable, is always coupled with high probable smart money reversal, and there's no there's no smart money reversal on this time frame. But on if you go to the lower time frame, there will be a smart money reversal, right? So price is fractal as always. Now, how do we determine that these gaps will remain open? We dive into this time frame over here. So we were on the 15-minute previous time frame, previous slide, and on this slide we are on the 5-minute, right? We have that SMT over here, and we can determine that there are breakaway gaps if we start to break structure, right? We were using market structure here. We're using the balanced price ranges, and we're gonna use the PD array matrix. So we know there's a bearish order block formed here because it rates this liquidity. We have SMT on it, and then we break structure lower. We have balanced price ranges, so these are being used as a resistance. And then we use the PD array matrix here, right? This bearish order block. So market structure, closure, balanced price ranges, and the PD array matrix is key. Now, where would you enter? Now we know, let's go back to the previous slide. Now we know this will all stay open because in this piece of price action, we just determined that there will be no delivery above this high anymore because of what I just explained. And now we can find an entry by entering on the order block. Put your stop loss above the order block. That's where the SMT forms, so it should be a strong high as well. And then you try to write it down. And even though we're below New York midnight for sells, this way you can determine that sometimes it will not go above daily opening price, for a sell. So I hope you enjoyed this. We're gonna hop into a simulator now, and I will see you in a bit. Right, so let's hop into the simulator and see if we can find an example of the concepts we just outlined. Let's just do Euro USD, and let's get a random date, as always, 23rd, 20, 23 October 2023, 2023, October 23. Right, so let's load up this simulator, and we're gonna see if we can find balance price ranges and go through those time frames, right? See if we have a breakaway gap. So what I want to do is do a higher time frame analysis first, right? Where is price most likely to go? Because those breakaway gaps most likely will form with order flow. So if you're bullish, right, the bias is bullish and the drawn liquidity is an old high, you want to see bullish breakaway gaps, right? We're not going to look for bearish breakaway gaps. So on the daily right now, it looks bullish, not gonna lie. Even though it's like slow, it looks to be reaching for this high over here because we're closing above this down close candle here. We're disrespecting a bearish fair value gap, so the next drawn liquidity looks to be this high over here. So now we know our drawn liquidity. Buy side liquidity. Right, and let's go to the 4-hour. Yeah, this also supports this thesis. So we have a fair value gap potentially being formed over here. Right. Okay, a little gap over here. Will this gap stay open? We're gonna find out on the lower time frame. What do you think? I think yes, right? Because we have this down close candle, which should support price higher. If we are bullish, then this gap down here will stay open. So now we have a swing low, which could push for the next leg up. Also have this liquidity rate down here, so we don't really need to go lower. It's consolidation into another expansion higher as the drawn liquidity is up. Let's go to the lower time frame, see if there's something here where you can take a trade from, right? So now we know this 4-hour fair value gap is a breakaway gap. So outline breakaway gap to the bottom, to the top, right? And this is that 1-hour bearish candle, right? 1 hour plus LB. So now if you want to trade the session, right, where do you want to be a buyer? And assuming where the breakaway gap is, this is where you can put your stop loss as well. So we can see a fair value gap here on the 30. So you can literally just put a long order in this fair value gap, put your stop loss at where the breakaway gap is on the 4-hour, right? Because this 4-hour gap should stay open. This candle is not closed yet. So technically we can assume this to be the low of this 4-hour, and this will be a breakaway gap as soon as we hit the discount and move away from it. So let's just put in an order over here. And what was the draw liquidity, right? This buy side liquidity. See if we can, yes, over here, right? So we want to aim for this high. There's a 123.3 R, which is pretty good. So let's put an order in here. So buy limit, right? So now we assume trading back into this down clock candle. And if we get hit, then we should just draw into the highs over here. So let's go to the 15, see how that looks like. All right, we get tagged and we push up. Now we can do the same thing on the lower time frame. After we hit buy side liquidity, it is likely that it can go back to internal range liquidity. So let's look at the 4-hour. 4-hour hasn't closed yet, but based off this 1-hour candle, we can assume this will be a breakaway gap in the future. We have this 15-minute structure currently. Let me remove this. We can see the orders over here, right? We should still push up. So let's see if we can form another fair value gap. Do we have one? Yes, we do have one over here, but because we ran external, it can return back into the fair value gap, right? So let's go to the 15, see where this goes. Right, still open, right? Look at that. Still open because of this candle. And this is the thing with wicks and bodies. The wicks do the damage, right? And the bodies tell the story. That's why you don't go break even. too early, because that wick might go very deep inside the range and the body will still close above where it should close. So that's why I'll only go break even once I see multiple arrays being respected in my way, right? So 4-hour breakaway gap, right? Still intact based off that 1 hour, which we outlined earlier. Went very deep, almost went in the gap as well. Some were wondering what caused for this move, but anyway, it's a simulator. So let's push up, let's push further up, and then we hit that buy side liquidity. So even though I entered before that 4-hour fair value gap was formed, right, we could already anticipate this gap to stay open because of this 1-hour structure over here. Down close candle should support price higher, and you can see that literally happening over here. Just buy the down close candle, put your stop loss where the breakaway gap should be, because you're assuming price won't come back in that gap, right? So yeah, I hope this video was helpful to you. If you do, like and subscribe as always. I will see you guys in the next video.